Hello everyone and welcome. Today we're diving into a topic every future homeowner, especially young adults building credit, needs to understand. We're challenging a popular belief about credit scores, the 30% rule for credit utilization. You've probably heard that keeping your balance under 30% of your limit is good enough. While it's better than going over, it won't get you the strongest mortgage terms. We'll break down why this common advice can hold you back and reveal the real strategies that turn your credit into a true financial asset. As a quick reminder, don't forget to download a copy of this presentation from my training website so you can print it, study it, and make notes. The link to the training website is on the screen and in the video description. And if you enjoyed this training, be sure to subscribe, like, and comment. Your feedback helps us grow and reach more agents like you. Many of you might be diligently keeping your credit utilization below 30%, thinking you're playing the credit game perfectly. Let's call this our wake-up call. Imagine you have a credit limit of $5,000, and you always keep your balance around $1,450, which is 29%. You're consistently under the 30% threshold. Yet, when it comes time to apply for a mortgage, you find your score isn't as high as you expected, and the interest rates offered aren't ideal. This happens because simply staying below 30% often puts you in a category where lenders still see some risk, preventing you from accessing the absolute best terms. The goal isn't just to manage credit, it's to command respect from lenders, and the 30% rule, while well-intentioned, often falls short of achieving that. So, what exactly is credit utilization, and why is it so important? This concept makes up roughly 30% of your FICO score, which is a significant portion. Put simply, it's about how much of your available credit you're actually using. The calculation is straightforward. You divide your total credit card balances by your total credit limits and then multiply by 100 to get a percentage. For example, if you have a $1,000 credit limit and a $300 balance, your utilization is 30%. What lenders see in this number is a signal of your financial discipline. High utilization suggests a reliance on debt, which can be a red flag. Low utilization, however, indicates excellent cash flow control and financial stability, making you a much more attractive borrower. Let's reframe our thinking about that 30% number. For your credit score, especially when you're looking for a mortgage, aiming for 30% utilization is like aiming for a D- in school. It might keep you from failing, but it certainly isn't going to get you into the best programs or unlock the best opportunities. In fact, FICO high achievers, those with scores above 785, typically maintain an average utilization rate closer to a mere 7%. The 30% threshold is really just a safe zone myth. It keeps you in the game, but you're not winning it. To truly elevate your score and position yourself for financial success, particularly when buying a home, we need to aim much higher, or rather, much lower than 30%. Let's visualize the impact of credit utilization across a spectrum. In the danger zone, with utilization between 31% and 100%, your scores are heavily penalized. Lenders see significant debt reliance and high risk, leading to harder loan approvals and much higher interest rates. Next, there's the managing stage from 11% to 30%. This is where many borrowers currently sit. While your scores stabilize here, they don't accelerate, and you're still looking at suboptimal mortgage rates. But the true sweet spot, the elite territory, is where you want to be. 1% to 10% utilization. This is where FICO high achievers live, where your scores truly climb, lender confidence soars, and the best mortgage rates become accessible. Our target is clear. Consistently aim for 1% to 10% utilization. This range transforms your credit from just a number into real buying power. Many people assume their credit utilization is calculated at the end of the month, or that paying their bill on the due date is enough. But here's the snapshot trap that catches many off guard. Utilization is captured at a specific moment. Let's say you spend $2,000 on a $5,000 limit card, hitting 40% utilization. A few weeks later, on your statement closing date, your credit issuer reports that 40% balance to the credit bureaus. You then pay your bill in full on the due date, feeling responsible. However, the damage is already done. The bureaus recorded that high 40% utilization. The elite move is to pay your balance down significantly, ideally under 10% before that statement's closing date. This way, you control the lower utilization percentage that gets reported. This is a critical insight for managing your credit effectively. Always aim to pay before the snapshot, not just after the deadline. While paying your bill in full by the due date is indeed responsible and prevents late fees, it doesn't protect your credit score if your balance was already reported high on the statement closing date. Credit bureaus essentially take a photograph of your balance at that specific moment, not a video of your payment behavior throughout the month. To truly optimize your score, you need to shift your payments earlier. Ideally, pay down your balance a few days before your statement closes. By doing so, you proactively control the story your credit report tells, ensuring a consistently low utilization is what lenders see. Let's talk about the real-world impact of your credit score, especially for homeownership. Consider two individuals, one with a 680 score due to 30% utilization, and another with a 740 plus score, achieved with 5% utilization. The 680 borrower might qualify for a mortgage, but they'll likely face higher interest rates, less negotiating leverage, and significantly higher total costs over 30 years. They might even need a larger down payment. The 740 plus borrower, however, commands lender confidence. They qualify for the best available rates, have a stronger negotiating position, and can potentially save tens of thousands of dollars over the life of their loan. Understanding and actively managing your credit utilization is not just about a number. It's about achieving your dream of homeownership on the best possible terms. Now let's put this into action with 3 powerful strategies. First, adopt the 10% rule as your new ceiling. Make it a hard limit for your credit card usage. Consistently keeping your reported balances below 10% of your limit will significantly improve your credit score over time. Second, embrace micropayments. Don't wait for your monthly statement. Instead, make small payments every few days after making purchases. This ensures your balance stays low throughout the month, dramatically improving what gets reported at the snapshot moment. Finally, consider requesting limit increases strategically. A higher credit limit automatically lowers your utilization if your spending remains the same. However, this is only effective if you are disciplined with your spending and don't see it as an invitation to increase debt. The 30% rule was never the goal. It was the bare minimum. And when your future home is at stake, the minimum isn't enough. Your real target should be 1 to 10% utilization, practiced consistently, not just before a mortgage application. Control the snapshot by paying balances down before the statement closes. You decide what gets reported, so use that power. Your score is your buying power. Every point means better rates, more options, and long-term savings. Credit isn't a barrier. Managed strategically, it becomes the bridge to homeownership. Stop asking, "How much can I use?" and start asking, "How little should I show?" That mindset shift is what moves you from renting to owning your future. As a final reminder, download the presentation from my training website so you can print it, study it, and take notes. The link is on the screen and in the video description. Thank you for watching, and don't forget to like, subscribe, and share.